Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out onto the internet. The best place to do that is to follow me on Twitter at Focus Compound. If you're interested in learning about our money management services, you can go to focuscompound.com and click the Invest With Us tab, or reach out to me directly at andrew@focusedcompounding.com. So, Geoff, how's everything going on your end?
Good. Yep. Yeah, you have
any surprises or anything?
No, not really. I mean, the market's up quite a bit by now for the year. I don't know if that's a surprise or not exactly, but other than that, we've talked about some of the other things. The banking stuff basically is the only big things that have happened so far this year. Is the period around the time of the Berkshire meeting and the different banking stocks that were dropping a lot, and the few that were taking over and everything.
If you would have had a crystal ball at the beginning of the year, and I would have told you that that was going to happen a few months later, would you have guessed that the market would be a little bit more turbulent? Or are you not exactly surprised that here we are, as you see on the screen, the S&P 500 is up about 11.5%. And that's just the price movement. That's not even taking into account dividends, I believe.
Yeah. I probably wouldn't have guessed that it'd be up that much. And probably definitely would have guessed that there'd be more turbulence overall, more volatility. But these things generally don't turn that quickly. The entire stock market, and usually you have the median stock do worse. Just the number of stocks doing well do come down lower and stuff. You don't necessarily have the biggest things that make up an index like the S&P 500, the Dow declining, and that usually goes on for quite some time. So, yeah, I mean, 2000, 2007, all those things were much slower than I would have expected. COVID was fast, but the market bottomed in early 2009, probably a year and a half after the bad, probably a year and a half to 2 years after the really bad subprime news started happening and everything. So for a long time, people said, "Oh, you'd expect it to be much worse, and then it was even worse than they expected, probably." So I think that .com was definitely the same way too. The market stayed up longer, but other things started dropping a lot, and so I think it's somewhat similar now. The indexes look pretty good and stuff, but if people were in individual stocks, it wouldn't look as good depending on what stocks they're in. Smaller things, the average thing, it's more mixed. Yeah.
Do you think it's complicated because we talked about on the last podcast that something like 96% of the performance this year is from the 5 stocks: Apple, NVIDIA, Google, what else was in there? Microsoft. And most of those businesses are what I think we would categorize as being like pretty decent businesses. Now, the valuations at 30 times PE is probably questionable. I'm looking at Apple right now. We could quickly look at Google. So Google is at 27 times PE. NVIDIA is at, a zillion times PE, but we could look at Microsoft as well. Looks like 35 times PE. So these are all pretty premium multiples. And I don't even think they've had any sort of multiple compression, have they? Since, let's call it 2021. I mean, their multiples have stayed.
Some of them have
higher.
Expanded or stayed the same. Yeah, I mean, Microsoft may be same, maybe a little contraction in Microsoft, but most others we're talking about have probably expanded a bit. Certainly, Nvidia's expanded a lot.
I guess like the backdrop or just sort of the situation, right? Like we always talk about how if you're running your personal capital, you would try to come up with only your personal capital. You would try to come up with like one idea a year and you would allocate that money into that idea and you just would never sell. And the thought process behind it is over time, the winners just make up such a big part of the portfolio, right? I mean, can you kind of think of that as the S&P 500 at this point, where these 5 stocks make such a huge or take up such a huge part of the S&P 500, and so much of the performance comes from these 5 stocks, where it's like, well, maybe these stocks are actually pretty decent. These businesses are actually pretty decent. Most of them, they're not trading at, like 90 times earnings or 70 or 80 times earnings, where it's like, yeah, you could see how the markets could continue to go up as long as these generals are still cooking and pushing along.
Yeah. They're not cheap. They're very expensive. So the thing I would use is probably price to sales or something like that more than price to earnings, because it gives you a better idea of the risks there. You can also look at things like gross profit and all that, but they're also very, very large. So the 2 problems that they have are that they can't really grow very much because they're too big, and then also the price is generally pretty high on a lot of them. Microsoft, I think we said it's over 10 times sales. So the other ones, I guess, here are more in the would be more in the mid, I don't know, more than 5, less than 9 times sales or something like that. But they're also very large, right? So, many of them dominate the areas that they're in. If they get into new business areas, then that would be where people expect a lot of growth. But actually, almost all of them that we talked about are very dominant in the business that they're already in. They've already kind of saturated it. And so it's just a question of whether there's new business areas that will grow a lot more for them. Maybe Microsoft and NVIDIA. People are taking into account other things that haven't happened yet, with AI and other areas too, but mainly AI stuff, I think. So it's kind of a reverse of, a period, whatever, 10 to 15 years ago with Microsoft where it was cheap.
So you're a avid movie watcher. Apple the other day announced their next big thing, their next product line they're coming out with. It is called Vision Pro. And this is a form of augmented reality. So a virtual reality mixed in with the real world. Did you catch any of the videos or anything on this new product? No? Okay. No, so basically it's, if you're familiar with Oculus, I mean, it looks very similar. Facebook acquired Oculus, obviously. But I mean, as you can see right now on the screen, I mean, they're betting on this version of augmented reality where you're going to be able to, surf the internet, check your email, watch movies, do all these different things, and all through this sci-fi looking goggles that they created, which the goggles actually, I think, don't look that bad. But what's the price? I think it was something, I mean, it's totally typical Apple. I think it was like $3,400 or $3,500 or something like that. I don't know if we could actually like pre-order it right now or something. It says notify me, but I don't know. I just thought it was funny because I remember one time we were talking about the dominance of certain things, and we were talking about, I believe, the iPhone, and how, yes, the iPhone is so important to most people in, today's world and stuff. But, when you're thinking about like how durable a product is into the future, I remember you basically said, yeah, I mean, I don't know. I mean, am I one day going to click my forehead and, be able to like make a phone call like that? And it's so, so it's just interesting just seeing this new product line that Apple's coming out with. And, the boomer in me says, I hope this doesn't take off because, that's kind of weird. But I don't know. I mean, people, I think, say that in every new cycle where new technology comes on board and it's something different, So I don't know. I think it's interesting. I'm just not exactly a fan of this whole metaverse thing. And you could probably argue that this is could lead to some form of that maybe in the future. I don't know, just the next step. But yeah, so I just wanted to bring that up because I thought they were interesting.
Yeah. I think probably Facebook sales have declined, from what they were at one time. So I think sometimes these things, pick up in a big way and don't. Most Apple products probably haven't picked up that much in terms of sales at any point, but you have a few that did very well. And obviously the iPhone is the key to their business there. This is a much more expensive product. The thing with where you're talking about the, people rooting against this sort of thing being adopted and everything, I think the difference with a smartphone and this to people is a smartphone was very sneaky that way, where they didn't think that it would change their life. And then it did. Here we're talking about something that seems like a very sci-fi concept to them and out there, and the people who are buying it are probably early adopters of that kind of thing, just want to try it out. So with any of these we'll see, but it depends on what content is actually made for it. It's not, I don't think it's that important, like what the hardware is and stuff. That's the problem with a lot of the things in the entertainment stuff, is that they don't make anything for, there's just not enough content for it being used for entertainment purposes, certainly. But Apple has a very big base of people who develop for other things for them, so it would make sense.
Got it. Cool. So I wanted to bring up a couple things on the podcast that we've talked about in the past. So we've talked a little bit about Six Flags and how the stock had some of the highest insider purchases that you've seen in quite some time. It stood out to you, and as you can see right here on this chart, these are the P for purchase, which is on Inside Arbitrage, which is a program that we're going to be using a lot on the podcast. But recently, the CFO started buying some more stock, and you had sent to me a recent earnings report that Six Flags pushed out, and the stock is up a little bit since that report, I believe. But I wanted just to bring it back up. I mean, do you ever think about like these insider purchases as like a form of signal, if you will, right? So you get a new CEO that comes on board, and we talked about how that CEO was at Middleby, and that was a very successful endeavor for him. I mean, the stock was something like a 100-bagger or something, right?
Mm-hmm.
And then he goes over to Six Flags, and he's going to, look to make some changes with the company. I mean, we like the asset itself. We like, the company itself, and, there's probably room for change there. But just wanted to know, like, what stood out to you about Six Flags in their first quarter performance. And now you have the CFO that is looking to, or who is buying with his own money in the open market. And, kind of how do you take that as a signal as opposed to noise, and what your general thoughts are on Six Flags? We haven't talked about it in a few months.
Well, the signal is pretty clear that they are betting big on it, betting big on having high incentives for it. The whole way that worked out, they brought in someone total outsider, and he brought in lots of other people into the company, and they're compensated a lot with equity, and specifically with hitting certain goals in terms of adjusted EBITDA or whatever they define it as in a few years. So it's a setup that a lot of investors like that way, right? That doesn't mean that they'll achieve it, though, right? I mean, I don't know how important incentives are. They may matter in some ways, that this is a goal that they're going to try to achieve, but just because you incentivize people a lot doesn't necessarily mean that's a goal that they can achieve. And generally, certainly top management and stuff, it doesn't have any experience in this industry, may not have a good plan for the company, whatever. There's no overlap with Middleby in terms of what the businesses are like at all. So that's a bit of the issue. And also some of the things they do with Middleby, they really can't do with a company like this. A lot of that was driven by different things, but a lot of it was driven by acquisitions and growth in different ways, and latching onto kind of growing with a few big customers, right? And this is completely opposite from that kind of thing. So those are the situation basically, is that there's a lot of incentives. There's the possibility that if they do hit it, obviously the stock's very cheap, and you could buy long-term options, you could buy the stock, you could do lots of things to do well over the next 2 years or so. But I don't know how realistic it is that they'll hit those goals or anything like that. The companies, what's interesting about it is the decisions that they made were taking it in a different direction from what's kind of been the problem with the company. So they focused on improving earnings, basically, on targeting things like EBITDA and stuff, and without necessarily improving attendance a lot. Analysts, I think, are pretty skeptical of that, and the investing public reacted really badly, selling the stock and stuff when they had bad attendance numbers. But lower attendance, but higher revenue, higher gross profit per person visiting the park is definitely a recipe for better success for Six Flags if they could do that. I don't know that they can do that because you might have to spend more on CapEx for that, and you might have developed a poor reputation over a long time, and you also might have conditioned people the same way that, you know, Joseph A. Bank did, or JCPenney or something, to expecting certain kinds of sales and promotions and stuff, like very low season ticket things, and giving away a lot of food and stuff like that. So those are the issues. But Six Flags has a very poor level of revenue per visitor, basically, per time that they visit, compared to what's at the parks and everything. So, and I don't think it has.
Why do you think that is?
They pursued that as a strategy, basically. I mean, I think that they've even showed in their investor presentations. I think this company has since the CEO took over, but I mean, it's not a secret. The company's admissions, you know, have adjusted for inflation and stuff. Basically, they're down a lot in 25 years. This park is getting cheaper and cheaper to go to over a long period of time. Certainly from the time that I remember it, going back 25 years or something, it was more expensive than what it is today. The gate, the to get in.
Yeah, the admissions fees. What are your thoughts on when a CEO from a different industry comes on board in a different business that's in a totally different industry, right? Like, you don't see Bob Iger trying to run a steel company or a coal company or a oil company. I mean, is that generally something that would make you a little bit skeptical?
No, I mean, the best experiences I've had of people that came from totally different industries just wanted to run something and did it. So usually they're a lot younger. I guess a second career could be okay. I think it's a little dangerous because they could be trying to prove themselves somewhere else after that. But I've had that's been fine at other ones. So the most common one I've had is someone that ran something or did something and then wanted to have either a second career or was really young and doing it. So someone who's just really interested in business and wants to take over something and do like what Buffett has done at Berkshire is usually the best setup that I've had ever in terms of CEOs and stuff. It hasn't been coming from the same industry generally.
Why do you think that is?
Well, there's some problems of coming from the same industry. So a few. One, obviously you don't need the same skills that other people at the company will have, right? So if you're the CEO or something, if you're taking over a company at which everyone else has been working at the same company or the same industry, then you don't necessarily need a lot of understanding of the industry if you're able to understand business, understand people, and be able to motivate them to do what you need to get done to drive results, right? So they'll have that knowledge. At other companies, you may need to have it, you may not have that, and so you need to bring a lot more of that as the CEO. But generally duplicating skills that other people at the company have isn't necessarily helpful, right? There's no reason, say, to entertainment, the CEO, right, to be the head of an entertainment, the entire company, like Iger or something. You don't need to have the skills of running the movie studio if you have someone who's good at running a movie studio. If you don't, then you do need those skills. And you definitely need skills about understanding the things that people might not be telling you and being able to evaluate the things that they might not be honest about and stuff. So, but yeah, I don't think a lot of technical knowledge of the industry is important, usually at all.
Interesting. What do you think someone like Bob Iger, like what's his, if you had to guess, like what do you think his average day is like? I mean, they're just so big and have so many different things going on at Disney. I mean, how do you think someone like him on such a vast scale like that really steers the ship?
I don't know. I don't have a lot of detail on what Disney's makeup now is like versus what it used to be. I mean, he wrote a book. He's not a details-oriented person, I would say. Big picture type person, not heavily financial-oriented person. So probably a lot about the personalities of the people, who to promote and who not to, what people to talk to, and all of that. But pretty people-driven. They have internal large things, or had at Disney, all sorts of different planning things and different committees and things and all sorts of complicated stuff. Some of the reorganization of that, I think, is part of that, is taking certain decisions and giving them directly to individual people for how to use content instead of having it part of a committee to decide what to do with certain content. So, yeah. But there's even some board-like structures inside Disney at levels before you get to the CEO, or there had been.
Yeah, interesting. I was playing around with this tool inside Arbitrage, and we've talked a lot about Buffett and his constant buying of Occidental, and thought it was interesting to see that all these purchases, they are, I believe, all Buffett. You could hover over the P and it says 10% owner, Berkshire Hathaway acquired, blah, 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 blah. But it looks like he has a buy price, Geoff, of stock anytime it's under $65 per share. Because if you're looking at this chart right here, I mean, he's never buying, around 65. It's always when it's like below 65. And it reminded me a lot of what we do, right? Like you give me buy instructions, buy up into this price, right? You have like a top, for example, and you typically don't, waver from that. I mean, really at all. So I'm just curious where that comes from. Because I feel like most investors are just like, I just want to get it. They're not patient enough. They just want to get it. And then they'll just, acquire the stock for the sake of acquiring it. I mean, obviously, if you look at this chart, Buffett is sort of in the same camp as you, where it's a little bit more strategic. I mean, because you could see he's buying a lot between like $55 and $60 a share, sometimes a little bit above it, but definitely nothing above $65 per share.
Yeah, we talked about that, where he said when it's around 60 or something, I think we'll just see him buy a lot. I think one of the important ones with this stock is the volume. He even talked about that in the annual meeting one time. So I think that if he finds a stock where he can get a lot of volume in the open market and everything, then he might buy it over time that way. And that also allows him to be able to buy at the price that he wants and then not do anything when it goes up a lot more, which you've seen here. I think, he's also talked about how it's a mistake sometimes to do that. Probably thinks that Occidental is less likely to be that kind of mistake, where not paying up enough is not as dangerous as if he has a really great business where he's afraid that he's not buying enough. And then also just he's been getting filled so well that I don't think he's been tempted to buy at higher prices, because he's been able to buy up so much of the company at prices that he's wanted, because oil companies are so heavily churned as stocks. So I think that's also a big part of it. If you're more likely to pay a higher price over time if the stock is very difficult to acquire, but if there's plenty of volume, then it's easy to stick to a particular buy price.
Why do you think they're so heavily churned as stocks? I mean, even at this point, what do they make up of the S&P 500? Energy companies, yeah. It's like nothing, right?
Yeah. I don't think people necessarily pay a lot of attention to each individual stock, get attached to it and everything. It's where we talked about regional banks too, the same way. I don't think people pick specific ones out. People who are in Occidental are probably in other oil stocks too. And there's lots of oil stocks, but I don't see a lot of individual shareholders that are big in one and not in another. They seem to buy across the category, so it's like a macro type thing. Even in cases where there's big differences in performance long term between different companies, there isn't necessarily short term, that they move together a lot. So it's something I've noticed both with oil companies in the United States, below the very, very biggest ones, and banks, that you don't get people who buy individual ones in a big way. They buy them as a group or something like that. And they may buy the very biggest ones, the top, 4 or so in size, picking out one of them, but they don't do that for smaller ones. So there's probably very few people that would own Occidental and not own lots of other oil companies. They want to do like what Buffett's doing, right? So he's in Chevron, he's in Occidental, very big in Occidental percentage wise. So probably likes Occidental a lot more, but can get more Chevron. But isn't just wildly buying all oil companies. Most people who are managing even a lot less money than Buffett might be more diversified across oil companies, but that's typical of him, just as he was in banks, and that was unusual compared to other people in banks. So he picks out specific stocks.
A few months ago, we talked about Dillard's on the podcast, and Ted Weschler's investment in Dillard's is what we hit on. They recently approved a $500 million share buyback, which is 10% of its market cap. And the stock is up 1,144% from its 2020 low. It's had a pretty incredible run, but the $500 million share buyback, I thought we could quickly look at it right now and see if this is in the territory where if you held it, well, would it be you wouldn't buy more of it? You still think it's cheap? I mean, on here, price of sales, 0.8, EV to sales, 0.7. PE 6 times, EV to free cash flow 6.6 times, 10-year median margins on EBIT 6%. If you were to give a snap judgment on Dillard's, what would your judgment be?
Well, I mean, it's difficult, and it's always been difficult in terms of evaluating the stock, the business, in what it is, because it's in retail, which is not something that I understand. And it's not overpriced or anything, though. Obviously, if it gets the good results in the future, but what is the? I mean, it's had basically no growth for the last 10 years, right? And free cash flow generation has been very low. It's had a lot of EPS growth. It's had a lot of improvement in the business, but it hasn't had growth in terms of top line stuff we're talking about. And it's hard to know how much free cash flow it'll generate, but if it's run really well, then you can get pretty good returns from it. But there's lots of retailers that I've looked at before, and you think the same thing, and it doesn't go well. Berkshire's had bad experiences in retail too, so they often look better than they turn out to be because of how management runs them and the difficulty, the competition in the industry and everything. So you get a lot less free cash flow than you're hoping for. But here we obviously had a big change where they did very well in terms of generating a lot of free cash flow and stuff, improving the business. And, I think that may be part of what the original investment was and why this company, like we talked about in that podcast on it.
Have you ever seriously considered or gotten close to purchasing a retailer, or has it always been just, too hard pile for you?
We've owned retailers or things that are in retailing, but we haven't owned things like department stores.
Mm-hmm.
So we've owned more general or retail, I guess you could say. Basically food and cars, supermarkets and car dealers. So that's retail. And then we've owned other things that have a retailing aspect to it, but may have a stronger position in the industry and other stuff too. So they could be online and offline or something, but maybe they also produce a lot for the industry or something. So, yeah, but something like this, no, I haven't owned it. Owned something that just does like, a department store or something, no, or general merchandise, or like, probably you'd say a big box store like a Target or a Walmart or something. They're very expensive when they don't have growth prospects. I mean, they're very expensive when they do have growth prospects, and sometimes they're very expensive when they don't have growth prospects. Like Target and Walmart are not cheap stocks, and they haven't grown. They haven't gained market share and stuff for a long time. So, and then you have the ones that are cheap. Obviously, are usually having some sort of decline. And then you have a big response to like same source sales and all of that. It's hard to know because it really depends on how management responds to it. Also, there's not that many department stores are a little different, but in general in retail, a lot of them are like restaurants and stuff where they went public and a lot of the insiders got rid of all their shares and everything. So it's a very, very tough business in terms of if you try to grow it. It might be better if you don't try to grow it, when you have a good concept that you think will grow, we talked about Tractor Supply or something like that. Could you find that early on? When you have a concept like that, it's obviously very good to grow it, but the stock is often very expensive. It wasn't in the case of Tractor Supply. But they quickly, the market quickly recognizes any sort of unusual growth and rewards it really fast. I mean, we talked about Ollie's, I think, which I've been to and thought about and everything about what their business model is and everything. But that stock got pretty high price pretty fast, even though in most of the country and stuff, people shouldn't have a lot of familiarity with it. I think during COVID, Boot Barn did pretty well. And again, I think that the multiple expanded and everything pretty fast on that too when they see any sort of good results. And these are things that people have to look for because in New York, they don't know what an Ollie's is or what a Boot Barn is, So this is not like Peter Lynch times when it was a lot easier to find those kinds of things in food or whatever. Motels, any of those things. I mean, it's good if you have a few units and it's really attractive economics, and then it can grow all around the country, but you have to have it at not a crazy price. So you have to be early to find it. I'm not usually early to find the retailer. And then you have to own it while it has a high PE, but it's okay because of how good the growth will be. So once it's proven in one part of the country, it should be easy to see what the future will be until it gets to too many stores.
Even finding it early on though, right? I mean, how many of these companies are going public at $200, $300, $400 million market caps for where you can find it early, right? They go public at $1 billion plus at very high valuations, and then maybe they pull back from there. And that's when, potentially you would see it or come across it. And at that point, it's like, well, it's kind of past that phase of wanting to find it early at a low multiple before anybody else notices it.
Yeah.
Seems a bit like a conundrum a little bit.
Mm-hmm. When things are going well, they often get a high price for it and everything. We talked about that with the Container Store, which was a perfectly good business and everything. It wasn't growing very fast, but in the book Uncontainable, talks about wanting to sell to Berkshire and everything and not doing it because of price. Going with private equity, it went public at a very high price and then has been a bad performing stock for, a long time, probably down 90% or something, mainly because of the high price and the timing of when it went public. Because it's built more into how interested the market is in the stock at that time, right? It doesn't go public in the middle of the housing bust or COVID, times or whatever, which coming out of COVID times, I should say, which is more the danger for a stock like that. But other than that, it's not a terribly unpredictable business. So if you just go into a kind of frothier market, we haven't had IPOs for like a year because the people are too scared of taking the company public, meaning that they might get a price that is not a particularly high price, right? So that's how you time these things. So yeah, restaurants and retail and stuff are that way. So you have to wait a while to see how they do in terms of price to be able to have a price that's attractive. You have to wait until a period where they don't do well. And, that could be hard because you could misjudge the competitive situation in terms of their competition. Generally, they don't have, retailers rarely have moats or advantages or something. Usually they just are better operators. So I think it's similar to things like insurance and stuff. We talked about movie studios. Movie studios rarely have competitive advantage versus each other. The top 5 or something historically may have advantages over others, but it's just a question of who's running it, about how good the results are going to be. And I think that's almost always true with retailers. So, Walmart as a stock has not done well since Sam Walton died. So it's not that it's been a disaster or anything, but you would have gotten rich if you owned it when you could until he died, and then you would have not done better than the S&P or something if you owned it since he died. So I don't think that's unusual for any of those things. But so it's very execution driven, just like I think when we talk about insurance and banking and other things where you have to do things that anyone can copy, right? That's the issue, is that it can be copied right away. So if you do take certain strategies that others are unwilling to copy, maybe you have an advantage for a little while, but generally you can copy anyone and they can copy you. So it's a question of how good you are, and a question of how willing you are to do certain things too. So, if your motivation is more driven for getting returns for shareholders or something, then maybe it might be better than some other stocks. Because they might have some other motivations besides just getting good return for shareholders. They might not be willing to shrink and do all of that.
Yeah, you talk about timing the cycle with some companies, and you referenced or some industries, and you referenced restaurants. I mean, how many times has Tillman Fertitta took his company public and then did like some sort of management buyout and then took it public again and just timed the cycle? I mean, he's done it a few times, hasn't he?
Yeah. And we talked about Arc Restaurants on this podcast plenty of times. That stock was much more expensive in like 2007 or whenever, the peak was in that, than it has been for the last 15 years or something. And that's pretty typical. So yeah, you could, that had a large insider owner. You could have taken it private in some buyout or something then probably. And at some different time, taking it public at a time like that and stuff. That stock stayed public. And Landry's tried to buy ARC too, higher price than today, but they did try to buy it. That was also similar with NASCAR. There were some NASCAR things that were the same way with the tracks that went public. You notice that they always bought them. There's a couple of them that went public and then were taken private. And if you notice, they went private at lower multiples than they went public. So,
yeah. Well, in today's podcast, so what we did and what we are going to do going forward is I'm going to tweet out a poll with a few different podcast ideas. A lot of these could be, just Geoff and I coming up with ideas, or people emailing in, certain topics to Geoff that he thinks would be good to have on the podcast. And whichever topic, if I could find it here, whichever topic wins the poll, we're going to talk about on the podcast. And I don't know why I can't find it right now, why it's not loading on my Twitter feed. But the topic that we're going to talk about is ideas that you've passed on and why, right? You look at thousands of ideas a year probably, right? Probably some a little bit more in depth than others. But you come across ideas all the time. So I wanted just to walk through some of them, and we could just talk about it. And the factors that led you not to invest in the particular stock, and sort of reverse engineer it. Does it ever feel like kind of crappy when, you pass on a stock and it gets acquired for like a valuation that you thought, that's probably what the company was worth, and for whatever reason you just, did not invest in it? Or is it for you, it's like, well, you just made the decision, so you don't really think about it? I mean, one thing I've noticed after you sell a position, like it doesn't seem like you exactly follow the company too much afterwards, or you don't follow the stock price afterwards.
Yeah, no, it's never bothered me.
Have you ever sold a stock and then bought back into it? So like owned a stock a few different times? Same stock a few different times?
Yeah. That's a very good question. Yes. Have I ever sold the stock completely and then bought back into it? Is that that's an interesting question. I don't know the answer to that. It's possible that I have not. I've certainly sold to buy something else, but I'm trying to think, did I sell all of it? It might not be that's happened. But it's less common than you think that I'd sell a stock just because of price. So, do you
want to explain why you typically sell stock then? If it's not, hey, I made a mistake.
Yeah, it's changes in the risk situation, but it could be changes in other things too. The size of what's left in terms of, how fast it's likely to grow in the future and things like that. But it isn't just that it went up a lot usually. I guess it could be in some cases, but it's hard to say. I mean, I do follow stocks that I've never bought and follow stocks that I've sold. But it's unlikely that I would probably buy back something that I had sold, I would say, compared to other people. That seems to be pretty common when I talk to other people, that they've owned something more than once. Yeah.
So many people, I feel like it's like they either, you learn a name, you learn the story, the situation, and they trade around it a lot, they trade in and out.
Right. So, I mean, I don't want to get into detail on what things we own and all of that, but there's certainly stuff that we've repeatedly bought and sold, but we've never eliminated the position. So I wouldn't count that as the same thing. But if a stock doubles, we might sell it. And if it halves, we might buy it. But that doesn't mean that we ever got rid of it. So I guess to answer your question, you're talking about like getting out of it completely and then going back into it, that some people might be doing that. No, that would be real. I can't think of cases where I've done that.
Okay, so in that situation where we have still own the stock and, perhaps bought some more and then sold it, kind of traded around the position a little bit. Mm-hmm. Why have we done that? Is that more so you just being familiar with the price action and, how market they're going to think about it?
It would just be, that would be purely based on price, right? So some things are easier based on price. And so price and sizing, it would make sense if a stock doubles or something to sell it, and if it halves to buy it. I think something like Occidental that Berkshire's buying, I think he would be willing to do that kind of thing more. He owns so much of it, people would be paying attention or anything, but I wouldn't be surprised if, that's why I think the fact that he's buying at a very specific price isn't that weird for Occidental, and he might not have too big a range of what price he'd be willing to pay. And I would feel the same way about a stock like Occidental. You wrote up Vitesse, VTS, and that's one where, when I was writing up, it might have been 19 or something, I forget, it's around there, the stock price. And so that's one where at 30, we would have said, okay, it's a different situation than at 15, right? So you might have said, it's really attractive at 15. It might be fine, might not be fine at 30. And at 60, it's too expensive or something, Like, you only have to sort of think about it and do a lot of calculations and stuff if it's around 30 or something. If oil prices go down a lot, then, it could work out badly even at a very low price. But that's probably the kind of thing. So, if you were looking at 30, you'd say, okay, well, if it halves to 15, it's very attractive. If it doubles to 60, you have to buy at 15. You have to sell at 60. You might be thinking it was at 30. I say 30 just because when I wrote it up and stuff, I kind of said it's probably not worth a lot less than 30. But, trying to say what is like a fair valuation actually on it or something, like putting aside what the stock is, because the stock was a spinoff. And, it might have been 20 or something. I mean, it spun off below that, but when I was writing it up, it was already probably at 20 or something.
Mm-hmm. And you haven't written up a spinoff in some time on focused compounding. So I'm kind of curious, like, what stood out to you about VTS to write that? Was it purely a price thing then?
No, it was because it was a spinoff from Jefferies, and it had no debt, basically. It has a little bit of debt. And it said that it might not grow its reserves over time, that it would be focusing on its dividend. So that's why. I mean, like, where I've talked a little bit about that, why write up that stock and not write up others? There's a lot of U.S. oil companies, oil and gas ones that are pretty small, and all sorts of different ones that might be attractive, as cheap or cheaper, might be in areas people would like better. So for this one, for instance, here you're like mostly North Dakota and stuff, whereas Callan, right, CPE, is just in West Texas. So isn't that a more attractive place to be in terms of where you own the oil and everything, and less marginal than here with VTS? Yeah, but what's the history of that company versus the history of this company, right? So this company was created about 10 years ago inside Jefferies to buy up a bunch of stuff. They're non-operating interests, right? So some people might like those less, but actually that makes it somewhat more possible that they might not grow. I think it might focus on capital allocation because you only would see certain deals and only think of yourself as investing in those things. They'd mentioned that they might sell their minerals that they own and everything. So they might be less tempted to do other things. Whereas when we compare that to some of the others that I mentioned, and specifically something like Callan, they have debt, where this company doesn't have debt, right? So not having debt is important because then these other companies might have debt which they intend to pay down instead of, say, buying back a lot of stock or paying out a dividend. Whereas if you're operating closer to neutral in terms of the balance sheet, you might be more likely to pay me out a dividend or to buy back the stock. I wouldn't want you to pay down the debt, right? Because if even if, say, the debt was, 7% or something, whatever would have been, let's say it's 8% or something, and which would have been a pretty high yield at the time that you took on the debt because yields were so low. Which is actually like junk debt at that time. I don't think it's very attractive to pay off because after taxes and stuff, we're talking about something that's closer to 6%. Not all these companies pay quite high tax rates, but it could be close to 6 for some companies. And then a 6% or 6.5% after tax cost is not bad. I mean, I wouldn't want to take oil out of the ground and use it to pay off something that's 6.5%. We don't even know that oil in the ground isn't going to go up at 6.5%. So I don't like that deal at all. You're doing something to take it out to pay now, to do this to pay off a financial debt that you have. It's not a very good exchange. So I don't think that I want a highly levered thing that's going to deleverage over time. I know a lot of people like that, but I don't like that idea at all. Yeah. So you'd want something that maybe might lever up or something that doesn't have leverage, right? I don't really want right now a company to say we're going to focus on delevering because you're paying down cheap liabilities and you're using potentially valuable assets to do it because it's not like oil is necessarily overvalued. We've talked about this. I mean, if you look at the long-term averages and stuff, oil seems fairly normally valued, and yet junk type credits certainly don't seem any more out of line in terms of pricing versus oil and stuff, especially when you consider what interest rates are now, the spreads on it and everything. It's just, I wouldn't do it. I wouldn't sell my resource off, basically, to my real asset off to pay off this money, this paper debt that I have. So that's a big part of it is the capital allocation. And some of these, I've done all sorts of acquisitions and issuing shares and all of that. And so that complicates it.
And they were doing the opposite, right? They're buying back stock. I mean, does this have all the hallmarks of you could be a stock market genius type of spinoff, or would you say not so much?
Yeah, it has that. That doesn't mean it'll work out well, but it has that, yeah. I mean, but they spun off Crimson Wine, which I never liked, but the same co-founder of Leucadia, who was in Jefferies, because Leucadia's merged with Jefferies, kept his shares in that stock. So we'll see what happens, but it's possible that you'll get a pretty fair price in terms of what gets paid out to you, and eventually they might buy things back. They'll probably acquire more or do more than I want them to do, but it was willing to write it up because it was more potentially unique compared to other companies. It's closer to what Buffett would want, what I would want in a business, in that you'd be willing to buy into oil things if you had a company set up like this, where it had been built up over the last 10 years or so, and now is willing to pay out to you.
When you thought about the range of outcomes, we've talked a lot about how oil is basically at a normal price, for example, and at the price that you wrote the stock up at, I mean, it was a 10% dividend yield, was the thought of, okay, they have very little debt, they're going to buy back stock, they generate a ton of free cash flow, and they pay a huge, dividend yield, or it has a huge dividend yield. I mean, is the stock going to trade more in line with other similar companies on a dividend yield basis, which could be way higher? If oil continues at a normal price, I'm going to make 10%. I mean, it sounds like to me there were a lot of, from a range of outcome perspective, there are a lot of ways to win in this stock.
Yeah, so, I mean, the price that I used there, did the calculation for the SEC calculation. You can mostly ignore the gas that it has. So it has a mix of oil and gas, and the oil alone would be worth about what you'd be paying probably for it. It helps. It's a short-lived asset, right? So these don't last very long. They have a pretty sharp decline in terms of what the production is going to be. So Buffett talked about that. So that does change things a bit. But obviously, the situation with inflation makes something like this more attractive. I think probably that's why Buffett's in things like Chevron Occidental and stuff, and that's why I would look at this and be more interested in it. To get something at a discount to give an idea, we talk about the present value thing, people talk about the problems with the present value, but the present value calculation is quite conservative in some ways. So the SEC has oil and gas companies do a present value calculation discounting at 10%, right? But they don't inflate the future results, prices and things. So future oil prices aren't inflated, okay? So that's like a 10% real discount rate. What's the likely nominal return that's going to be on the S&P or something? I mean, maybe is it 6% nominal, and here you have 10% real is what the calculation is being done at. And then here you're buying in at some of these companies at 2/3 or something of the value of it. It's just a lot cheaper. But it doesn't mean that terrible things can't happen with the price of oil coming down and everything, and you're very exposed to that. But so is it better to take a risk on, say, oil or something, and instead of being diversified across the S&P to get much more attractive potential returns, right? Because at that PV10, that's at a much higher return than the S&P. If that really happens, if oil prices really stay the same in real terms over time, you should get much better results from an oil stock trading at 1 times the PV10 than in the S&P. And then these things are sometimes available at 2/3 or half or something. I mean, on a leverage basis, when we talked about Callan, it was less than half. This is unleveraged. There's a couple unleveraged ones or close to unleveraged this, and there's another that are, that they're at 2/3. They were at 2/3 or something. Using the end of year pricing, it's a little complicated because they do monthly, the SEC. So you use the 12-month, the average of the 12 months. So it was using like $90 a barrel oil or something. And much more expensive natural gas. But to be fair, both of the expectations for last year are pretty close to, both of the actual realized prices for last year are actually close to the long-term average price of the commodity. So if you look, the 12-month average for oil is not far from what the expected real price, I would say, would be. And actually for natural gas, it's really close to being exactly on. $6 is closer to the long-term average than 2. So we're at 2. But 2 is a very unusual price for natural gas. Oil, 75 or something, is a pretty normal price.
Okay, so $6 average, $2 today. I'm a little bit above $2. It's like $2.30. On the last podcast, you had said that you thought natural gas was very cheap today. Is that all on a normalized average figure?
Yeah. So natural gas, I haven't been that interested in natural gas for a little... mainly because of what happened about 10 years ago. A problem with natural gas is that you find it when you're looking for oil. So there's an extent to which it's a byproduct, and that is a potential problem if people are irrational about oil. But as long as they're not irrational about oil and stuff, and we don't expect too much oil supply in the future and everything, I think it can be okay. Yeah.
What happened 10 years ago?
Well, I just mean I don't remember the exact date of it, but that was the boom. There's a crazy boom in terms of finding oil in the United States, trying to produce a lot of oil, trying to buy up a lot of oil, whatever. And that didn't make a lot of sense. And I've said before that I think that's why now we're still suffering from that, in terms of that's why the capital allocation is different. It may also be ESG, but I think mainly it's different because of the companies that took on debt then and did all those things. There was a irrational exuberance or whatever about the future of oil, and a desire to, like a bubble. It was like AI, it's the same sort of thing. And so that led to some things that were worrying about natural gas longer term. Because I mean, it can take a while, but like the places we're talking about, North Dakota, Pennsylvania and Southeast Ohio and stuff, that we're talking about with NACO, eventually they put in the infrastructure and stuff so they can get the natural gas out of these places and everything. But the original reasons for why these things get developed and stuff, when they were originally, I mean, in all these cases, there was coal in the area and stuff first that they could find, and then they can find other things. is because of a desire to produce a lot of, say, oil or something like that. Like there's a belief that there's a lot of it there and they can start producing. And then eventually this could lead to too much natural gas. So we'll see what happens. But yeah, I mean, it's not that I think the $6 would be a normal price on natural gas, but certainly long term, there's no reason to believe that 6.5 or something is less reasonable than where we are now. In between those numbers, it's pretty reasonable. So, we'll see what happens, but I think we've talked about before, I don't focus that much on the demand side. I don't think it makes a huge difference whether we have a lot of demand for oil or natural gas in the future for whether you'll do well in investments in oil and natural gas. I think there's a lot of things about the economics of it, of what it costs in general, but also particularly the ones you buy into, what prices make sense in terms of the cost, but also just supply growth and everything. So,
so it's much more of a supply thing for you.
Mm-hmm. Yeah.
It's kind of similar to what you're seeing in home building right now, where rates go from nothing to 7%, and home builders are still, doing okay because we had this huge, I'll use your word, irrational exuberance from 2008, underbuilt in this country after, and now there's a shortage as it relates to supply of homes, and you're seeing that reflected in home prices. You're seeing that in home builders. It's a very much the same situation for oil. I mean, even look at like rig counts and all that other stuff, and that's continuing to be down. Mm-hmm. China's coming back on. I know these are very short-term things, right? But take that out of it, the demand out of it from like a supply perspective. Yeah, there hasn't been as much growth in supply over the past 10 years, whether that's ESG, whether that's a change in capital allocation. It's reality. So, and we've talked about so many times on the podcast, the capital allocation this cycle is different. I don't know. I think if you're an oil company, you don't know where your industry is going to be in 10 years from now, it's probably hard to feel comfortable about going out and, increasing supply. But as they say in oil, I mean, high prices cure high prices. If oil were to go berserk, of course, there's going to be supply that comes on board because that's just the nature of supply and demand. But yeah, it reminds me a lot of like the home building industry and homes in general in the United States over the past 10 years.
Yeah, well, since COVID, at least, homes and autos haven't, people have overestimated the extent to which those prices might come down and stuff simply because there hasn't been much of a change in the industry. It's not like the last time that this happened. There wasn't an ability for them to cure those high prices by bringing on more supply. They didn't do it. So they didn't change what that was in terms of, there's very limited supply of housing in the United States. So there wasn't enough time for them to make a big effort in that way. In individual single family homes, there was in apartments. They built a lot of them. So it's very different from what happened in the 2000s. Boom. So that's sometimes the price of something changes a lot, and we don't have a big response in terms of supply, right? And then sometimes that doesn't happen. We talked about Encore Wire, right? The price of copper could go crazy or something, but it's not going to change the supply of copper instantaneously like that. It can't. So that's just a blip that you have. You make a bunch of money. It doesn't long-term really hurt your business or something. You just make outsized profits for a little while. And it can't really have much effect on anything else. But if you had a boom in which people really decided that they need to open up more copper mines and stuff because they believe, China's going to grow at some phenomenal rate or something, then you'd have too much supply and then you'd have to deal with that for decades. But some things in COVID went crazy and you just benefit from higher prices but don't have a lot of extra supply come on, and then others you have a lot of extra supply. I mean, there's probably too many warehouses for, having Amazon things and stuff. And so we don't see that because we don't have data on that stuff, but it's probably terrible if you were in that business or something.
I mean, like a copper mine, for example, though, how long would it take for a mine to come online, right? To bring supply in the industry? I mean, it's not instantaneous.
Right. Mm-hmm. Yeah. So
I mean, nuclear reactors. How long does it take for one of those to come online?
I don't know. I mean, they haven't built one in the United States in 40 years or something, so they don't come online at all. But yeah, the project's always overrun and it costs a lot more than you thought and everything. Yeah. So I mean,
look at the lithium mine that NACO's trying to, that's part of. I mean, this is like a multi-year thing,
right? And that's a good point because lithium, for instance, has went up a lot in price. It's come down somewhat, but people are making a big deal of this. Lithium's not rare. Like, it's not remotely rare. Some of the things we're talking about, so say copper or say like, tin and things like that. Lithium is not a particularly rare thing in the world. It's not particularly hard. It's not rare. There's actually plenty of sources of it, probably. Many of them should be in very politically stable places. It's widely distributed around the world. So, the United States, obviously, it's hard to extract anything because of the issues that you'll have. In highly developed countries, it's going to be hard to build mines and things like that ever because of the political situation. Not in my backyard stuff, the disputes between the federal and local governments, environmental things, union things, all sorts of things. So it's always going to be really, really difficult in countries like that, as it will somewhat even in things like energy and stuff. California Resources is a public company. There are rules in California and stuff. You can't, they've made rules about living within a certain distance of, schools and things being within a certain distance of oil wells and stuff. And so, there's concerns that people might have even in places like that. I mean, that's a U.S.-based company. It's oil reserves in the United States, and people might be worried about what happens to it. That those reserves might be worth less over time because of rules in California that aren't the same rules in all other states.
Yeah, I mean, the permitting process in a lot of these things, it could take years, right? 2, 5, 10 years sometimes, if not more.
Mm-hmm. Yeah, and then that's what drives up the prices and stuff, But we've talked about that because that's a thing with lime and cement. Much less so, but also true just in aggregates generally. It's usually easier once they have a permit for something to expand and do all the other things. So a big part of the moat, right, is actually that you've already been approved in some place, that you already exist, that you're already polluting or whatever there. And then you can expand that much more easily than you can to be a completely different place. So having a reserve someplace that hasn't been developed may not be as good as having someplace that you can continuously expand. So it's, like having a TV license in some country or something. If you have a plant that's already producing in some state, similar to Copart, right, with a salvage yard. If you got one junkyard in town, it's a lot easier to grow that one junkyard usually than to get approval to put another one in. So you could end up with more of a monopoly than you might expect. Very dirty industries can tend more towards monopoly if there's not a totally free market where there's government intervention and stuff. The public can prevent things from happening or at least slow them down.
Mm-hmm. In my area where I live, there was a county thing where I guess I was reading about it online. I guess supposedly nobody goes to like these, county commissioner meetings or whatever. And there was somebody that was trying to start an asphalt plant here. And it like was a public outrage, and hundreds of people showed up, and the county ended up turning it down. But they're like, the county basically said that's normally nobody comes to these meetings, handful of people, but you're trying to put an asphalt plant in, and all of a sudden everybody cares, and it's this huge deal, and they come to protest the whole thing.
Yeah. Whereas if it was already there, you probably still would have moved there. So,
yeah,
I mean, that's why that's the advantage.
It was there 20, 30 years ago.
Yeah. So that's the advantage to having it. Yeah. And there's a lot of them are based on that. I don't think we've talked enough about that when we're talking about cement and lime, but certainly lime, it's pretty obvious that if you look at the record for the last 40 or 50 years, it's a record of 40 years or so, a record of it being easier if you already have a pre-existing site. So higher and higher concentration in individual sites and improving them and stuff instead of more sites. And Economically, it probably make more sense to be more spread out than it is. But politically and all of that kind of stuff, it makes sense to be less spread out. And that's good because it helps in the industry in terms of returns. It's worse for the consumers, but it's better for the firms in the industry that it means that you're spreading it out less, right? It would be like if you think about Amazon or something and they could deliver in 5 days instead of overnight or whatever. Their business would be better if they could operate out of one location and stuff instead of having to cover the country. But people want an Amazon warehouse next to them. They don't want a asphalt plant next to them.
Let's shift gears and talk a little bit about ideas that you've passed on and why, and what led you to pass on investing in that company. To start, we've spoken a good amount about Games Workshop on this podcast. You have said that you wish you would have bought it. You did a lot of research on it. And, would you consider that? I had this question written down actually when I was preparing. I mean, what would you consider to be one of your biggest errors of omission? I mean, would you put Games Workshop in that camp or not so much?
Maybe. It's really hard to tell because you have to have enough information at the time. So sometimes you say, okay, well, what if I focused on that? Would there be enough information? It's definitely possible that Games Workshop might be. So I followed the company. It was very interesting. Sometimes there's a company that looks very interesting, has an interesting asset, whatever, but you feel isn't being run particularly well, or it could make a lot more money if it was run differently. So Games Workshop had a CEO before where I thought that probably if they can make a lot more money if they operate the company differently. And then they had a new CEO come in when I wasn't paying attention and everything, and didn't buy the stock. And so that was a pivot that, it would have been good to buy in on that change. The only problem that I had with the company before was the previous CEO. Not anything wrong with him and stuff, just the way he was running the company and stuff. They could make more money if they operated the company differently. But you don't necessarily know that the new CEO is going to be completely different that way. But he did write letters and things that made it pretty clear what he was going to do.
So why did you pass on it? That's the topic today.
Yeah, I just wasn't following the company when it changed from one CEO to the next. Yeah. I mean, I passed on it before because of who the CEO was previously. Yeah.
I mean, we talked a little bit about that earlier today, but that could be a great place to look to, for ideas, right? Is when there's a company you love, but don't like the CEO, and then there's a CEO change that comes in. And we were talking about it offline the other day. What does the new CEO do? Well, you get to blame all the past mistakes on the previous CEO. You get to reset the deck a little bit and go a different direction that may make sense, right? Maybe there's a new CEO because what the previous CEO was doing didn't add any value. And maybe there are some basic fundamental blocking, tackling things that the new CEO can implement and, go a different direction with the company. So that's got to be a great hunting ground for great investments.
Yeah, this was a little better situation than that, but harder to see. The company probably was performing fine, and certainly didn't change CEOs because of performance issues that way. But it was probably vastly underperforming what it was capable of, as I think it was one of the more valuable IPs in the world. This is Warhammer, so the Warhammer, which is originally a fantasy game thing, tabletop game, but it's really the Warhammer 40,000 or whatever it's called. The futuristic themed one. That's the big moneymaker. So so it was like we were talking about Disney and stuff, right? So like Eisner taking over Disney or something, back then able to just raise prices and things with what had already been built up. It's more in that line. It was a company that was a lot better than I think investors realized in terms of what it owned and stuff. So there's lots of companies like that. I mean, most great IPs, great whatever things that you might own you're not making it, even those things where you're making a lot of money off of them, you're not making as much as you could be making off of them. So there's tons of examples of companies like that. When you have a decent enough return, people don't really complain that much and everything, and so they may not realize that you could be doing a lot better. So, I mean, investors tend to complain about the companies that are having this somewhat poor returns on capital and stuff, even if it's mostly because they're in an industry where they can't do a lot better than that. And they don't necessarily pick on the companies that have potential for even better returns just because they're already high versus their industry. So they like to look at a peer or something and say that if you're as good as a peer, then they don't really say, well, you should be a lot better because you're even better than that. So, I mean, you could look at I guess on QuickFS, it probably has some where you can look at the longer term results because this is a change that happened in the last 10 years. So if you look at
even look at their
something.
Sure. You could bring it up. Look at their return on equity, their return on assets, return on invested capital for people listening. In 2013, return on equity, 33%. And it looks like if I just going to eyeball the past 3 years on average, it's probably 60 to 65% return on equity. Gross margins have largely stayed the same. But EBITDA margins have basically doubled, going from 22.5% to high 40s. Operating margin going from 16% to 40s. That's a good tell, right? That there's a solid business there if you have pretty high, stable gross margins, right? And then maybe things could change on the operating side.
Mm-hmm. Yeah, so they always have very high gross returns on capital. If you look at the overview or something, we could see where the sales picked up a lot. They refreshed it with more things coming out more often, which drives higher sales for them when they do that. And driving higher sales through the same system just gets you much better returns, when you're having such high pricing.
Market cap was $228 million in 2013, by the way, and now it's $3.1 billion.
Yep. So there you go. It's 15 times something. It also buys back stock. It mostly pays out a dividend, actually. So one thing it did under the previous CEO on this one is that all excess cash they pay out as a dividend. So they normally operate a balance sheet that's pretty neutral. So it's a little bit like what people might expect VTS will be in the future. And not a crazy price, right? 7 times sales or something now.
Mm-hmm. Yeah.
Yeah. So not that it's cheap, but it's as cheap or cheaper than some of the other stocks we were looking at now, the FANG things or whatever they're called today. I don't know how much bigger it can get, but obviously the 99% of people in every country have never heard of Warhammer. So,
Stella Jones. We talked a little bit about this last year. We pulled up the investor presentation, and you're talking about the capital allocation, and you've written about this on Focus Compounding a few times, I believe, once or twice. What are your thoughts on Stella Jones? This, to me, is a business that I think Buffett would like.
Yeah, I think he would buy the whole thing, maybe, unless they're concerned about environmental stuff or whatever. They do deal, that is always a concern of mine. They deal with some chemicals that have an issue with them, I think. Just that, not for any of their customers or anything, but just that they have workers working with it. It's just that it's not cheap enough. So it uses leverage. It's always levered. So you have to be careful about that. So if we look at like enterprise value to sales, it's fairly normal to a little expensive. They can't ever convert at a very good free cash flow level, right? Because basically this is a company that makes poles it makes two things. It makes a few things, but the two ones that have been a major part of their business for a long time is it makes railroad ties. So it makes the wood part of the railroad track that you're used to seeing, and it makes poles for telephone poles, for utility poles, power poles that you're used to seeing in your neighborhood. And in addition to that, it also makes things for treated wood for like decks, basically for homes. So like selling the wood to a retailer who then would use it to make it into decks. Those are basically their business, but you have to season the wood, so it probably has to spend 9 months or something on average, their inventory just laying out there in a pile, like I think you see in that picture. Yeah. So that basically you have to finance that, right? If you want to make a good return, you can't just have it sitting there all the time like that. And so that's something that you have to do yourself. And so they've always used leverage, but you have to take that into account, that their actual free cash flow return is not particularly high, like compared to Games Workshop or something. This is a very, very low. The product economics are poor, right? So the competitive position is good, but the product economics are bad. You wouldn't want to be in this business. You're dealing with a few large customers who have a lot of bargaining power with you. Now, if you become their only supplier and everything, then you could say that you can bargain for that. And this isn't a particularly big part of their CapEx budget for these companies necessarily. But the product economics are not that good. And the competitive position over time has gone better. The operationally has gone better and everything. So that's where the advantage comes from. But it's the opposite of Games Workshop that way. This is very low gross margin, low turn type of thing. You need to use debt and everything. So yeah, it's better to own Warhammer or something as an IP than to season this wood.
They do buy back stock, as you said. They always have leverage.
Oh, yeah, the cap allocation, yeah. So it's just the history of this company has been that it's purely cap allocation thing. This is like an outsider type company. It's built up from the 90s, you could see. It's listed in Canada and the United States, so there's some confusion over that. But it's been a huge returning stock. It was a very, very small microcap when I first came across it. And it's just acquired lots of different companies in the same business that it's in all around the country, all around both countries, the United States and Canada. And then it's used debt as much as possible. So constantly, and then bought back stock. And it has a projection for free cash flow over the next few years that's pretty good. And then, well, it doesn't really have a projection for free cash flow, but what it has a projection for is like what it intends its capital allocation to be. And because of the way the company works, that suggests a very high level of free cash flow, even if they're not projecting it.
Mm-hmm. The outsider management or CEO that was at this company for a long time and turned into the success that it is, has since left, I believe, to go to a completely different industry, I believe.
Yeah, but like, I don't know that matters that much. I think they'll keep to the same capital allocation. I don't remember if. I don't think it did. The outsiders never talked about General Dynamics, right? After that. Oh, yeah, they probably did a little bit afterwards. But General Dynamics followed this outsider-type path through like 3 CEOs. Once they get into doing it and they see that their stock goes up, I mean, it's not a weird if your stock's gone up at 20% a year for 25 years or something, then you probably say, oh, we should keep doing the same thing we were doing before,
So for you, it was purely price?
Well, look at enterprise value to free cash flow.
Yeah, 29 times.
It's not low, because if you look at free cash flow margin, I mean, the free cash flow margin of this company is bad. It's 5%, right, is the median free cash flow margin. And EV is 1.5 times. So you're paying an incredibly high price versus free cash flow, because free cash flow is really low here. I mean, it's a little debatable how much value this company really creates, because if it keeps doing it, keeps buying back stock and everything, maybe this can work out. But this requires TransDigm like capital allocation stuff all the time, both in acquiring other companies and buying back your stock in a smart way, because you are paying for the earnings, basically. What people must be valuing this on is reported earnings per share and earnings per share growth over time. They can't actually take that much money out of the business and pay it to you. So, yeah. Unless it gets down to 10 times earnings or something, it's tricky, because you use a fair amount of debt and you convert so little into cash, right? Like I was just talking about NACO and everything and that, right? I mean, that converts a huge amount of the earnings per share and stuff gets converted into free cash flow over time. So it's just a difference, and yeah.
So purely price. So if it did get down to 10 times earnings, you'd probably take another look.
Maybe. I also don't know if they can buy any other things in the industry and stuff at this point. They're pretty big. It's possible that they could. So yeah, if it got cheap enough, maybe. It's very, very predictable. It just has these contracts that, it signs every few years with its customers, and then it escalates on price. It also, some of the businesses, the deck business, which I don't know if it might just drop off a cliff. But yeah, I mean, it's not a value price. It's at all. But, but when I was looking at it, even at 10 times earnings or something, it's probably not that cheap on enterprise value to free cash flow. It's just being willing to consider it when it's that expensive. It's very predictable and stuff, so it's one that I could see people who like moats and compounders and stuff to buy into.
Next company, Nathan's Famous Ink. We talked about this, I believe, in 2021 or 2022. Yeah, kind of right by the bottom. I think you're right around $50. I don't know how serious you thought about it and what your thoughts were on Nathan's, but we have followed this company for some time. So do you have any general thoughts on Nathan's? Do you like the business model? Do you like their capital allocation? What are your thoughts on Nathan's?
Yeah, I don't have a lot of thoughts on Nathan's. I tried out like their restaurant thing that they were testing out and stuff. So I tried that. So I sampled some of the product and saw where it was sold and went to locations where they were trying restaurant things and stuff. So enough to do some scuttlebutt on it that way, I guess. The product economics are good. You have this is basically a brand business. A lot of what you're seeing in the results here. So that's all good. They rely a lot on a company to produce for them. In terms of they break it down into a couple different categories. They say like branded products or something. I don't remember all the categories that they use to describe how they do it, but they sell some stuff through food service things. They sell some stuff through supermarkets and everything. And so the supermarket one, for instance, they're getting royalties on someone else producing it. Were there 2 books written on Nathan's?
Yep.
I believe so. Yeah, I've read both of them. Yeah. So, I don't know that I've ever gotten that close to buying Nathan's. I don't know that it's been that cheap. I don't know. We'd have to look. It's a pretty small stock.
Mm-hmm.
So
$316 million market cap.
Yeah, I mean, all these things that we're talking about are not cheap for the category that they're in normally. Like, it's not like Games Workshop, Stella Jones, or Nathan's Famous are unrecognized and cheap and stuff. They basically don't qualify as value stocks for the most part. And Nathan's had a very long period where it didn't perform well at all. Yeah, so I mean, from those books and stuff, it's had very, very long periods where it didn't do well. But it had a change in approach and stuff that you can see here in the last 20 years.
So never seriously considered it is the answer.
I think that's correct, yeah.
They're also going into like the QSR business as well. I don't know how that's doing, but I remember that's one thing that they were talking about for a little bit there, having their own little quick service restaurant, which I didn't know how that would do, quite frankly. I wasn't too positive on that.
Yeah, I tried it a few times to test it out because of that.
Hilton Foods Group, if I could, HFG. So we've talked about this. You've written about this stock on Focused Compounding. Last summer, the stock sold off a fair amount, a good amount. Let's see if I can find a stock chart. Let's see. So we're up 22% year to date, but it was this drop right here. So it went from, it dropped probably like 50% in September of 2022. You had followed the company for some time, wrote up the stock in 2020, 2019, that time frame. I don't know how serious you were about the company or if you were, but why did you pass on Hilton?
I don't have a lot of information on the company, and if I had more from management and what they do and stuff. I mean, I've read their reports. I don't think they tell you that much. Basically, the returns in the business have been getting lower over time, and so that's basically why not.
So like the gross margins are you referring to gross margins? Are you referring to like return on equity?
The margins aren't margins don't mean anything here because the company's like processes meat as a dedicated supplier. So you're building a plant with a customer. It's similar to like Ball or something like that, in which you're basically building a plant for a customer, that's going to then serve all their needs. So you sign like a 15-year contract or something, you build a plant, and one customer takes it in some of the earlier years for Hilton, or if you have a few smaller customers, a few take the capacity, and you produce all the meat for them. So like if you go to your Tesco in the UK or something and you buy meat, it may have all been packed by Hilton Foods, as in packing in terms of like the last part of the process of meat, of breaking it down into the portions that you're going to eat and packaging it in what you're going to see it over at the butcher's counter or whatever and all that. So it's the private label stuff that you see there. I think some of it is good that they've done some stuff in Australia and around there that has some upside. Because what tends to happen is that you can predict for a little while that like results are going to be better or something as they use up the capacity, but then once the capacity is used up, the results don't get any better. So, if they're operating at less than 100% capacity or something, that earnings are going to grow a lot. Like you could tell that they grow, but then once they reach that point, you won't expect any growth from the previous customers ever. Certainly in real terms, I wouldn't expect it to get better ever. So, yeah, if the company was more communicative and I understood it better and everything, I might be more interested. It's an interesting business model. The results have been good for a long time, but you see obviously that returns have declined over time. And what that's all about, I don't know. It doesn't have particularly high returns on capital and everything, so you got to be a little careful getting about price. And the price got pretty high. So even though coming down 50% or whatever, I mean, things like price to book and stuff, it's not cheap. I mean, none of the ones that we've talked about are cheap on price to book, for instance.
Yeah, I mean, return on invested capital, for those listening, in 2010, it peaked at basically 26%, and it's just declined ever since. And, the past few years, I mean, even before COVID, we're talking, I don't know, an average of 10%, I mean, 8% and 12% and in between there. So they've, it's drastically gone down.
Yeah. And they've, the other two things are they've made a series of small acquisitions, right? And they also haven't really brought down their share count and stuff. So share count stuff, the returns on capital with the share count stuff and with the acquisitions that they've made is more the issue. They've made a series of acquisitions, not all of them necessarily that exciting. They want to do other kinds of protein and stuff. The annual reports have a lot on ESG and everything, but because that's probably a big concern for them, because obviously they're mainly a red meat type company. I think they don't exactly say it, but I believe that a huge amount of their profits probably come from that kind of stuff. I think beef and lamb is big in some of the countries that they're in. It would be odd in the United States, but they're not in the U.S., and they are big in countries like the UK and, like I said, Australia, New Zealand. People in those countries eat more lamb than in the United States. So, but I think if you put those together, they don't make as much from poultry and fish and stuff as you would expect for a company like this, is my guess. But I don't know that.
Yeah, the shares outstanding have grown by about like 2% a year since 2013. For those listening, total shares outstanding, 72 million in 2013. And they're at 89 million today. I got to speak out loud what we're watching on the screen, Geoff, or looking at the screen, because I always forget that like 80% of listeners are podcast listeners, not on YouTube. So shares outstanding have grown by 2% in, the wrong direction. So
yeah, if we go to the overview, can you see what like the earnings per share growth and stuff has been?
Yeah, let's see. So 10-year CAGR on EPS, the opposite, negative 2%.
Right, because what's happened in the last few years in earnings per share, though?
Yeah, EPS has fallen off a cliff. So in 2022, there was down 56%.
Yeah, so I don't know. That could be misleading. There's inflation issues and stuff with that. They basically make a profit per, you could figure it out, but a profit per kilogram, they would say. And so I would expect that to adjust. Like we said, the margins and stuff will go back probably over time. It's just a cost, not exactly cost plus business, but you're just paying, over time they should be able to negotiate in a way in which they know that they make, say, 2 pence a pound or whatever it might be, 2 pence a kilo or whatever. There's just some amount that is going to be the normal amount that they make for processing the volumes that they do. So it's possible under the contracts that they have with inflation and everything that you could obviously have a cost impact that you can't pass on right away, but it won't last because they can't find any other supplier that will give them a cheaper price than this one. So there's not much they can do about it. I mean, eventually the supermarket has to take the price increase. It's not going to be absorbed just by Hilton Food. So I wouldn't worry that much if we're seeing impacts from inflation or something. Eventually it will adjust. So same with Stella Jones. It could get hurt for a year or something because it has contracts that run 3 to 5 years or something, but it's just going to reprice them. Certainly Hilton Food and Stella Jones have power over their customers in terms of you have to take the higher price because you can't go and find someone else who will supply this to you for cheaper. Some of their original plants and stuff that's serving Tesco and everything are very highly automated, very expensive. So the things they did in Australia, they seem like they'd be very economical and a good idea for a supermarket to adopt. But some of the other ones don't. I've seen the one that they have in Eastern Europe and stuff. It seems very, it's not highly automated. It seems like it's pretty labor intensive. It doesn't look that great.
Next one that we can talk about, which we did Scuttlebutt on in person when we first launched the fund, Dover Motorsports. They were acquired by Speedway Motorsports for $3.61 per share, which was an equity value of $131.5 million. We went and saw a racetrack that they were bringing back online outside of Nashville, correct? And we also went to Delaware as well, Dover, Delaware.
Yep.
And saw the park or saw the racetrack. So
the casino, yeah.
Maybe take us through with slots. Take us through Dover Motorsports. Was that more so a timing thing? Was it more so we just didn't have the cash at the time because we were putting it elsewhere? What were your thoughts on Dover Motorsports?
Well, management stood us up, so I think that was probably the reason.
Maybe that's why they stood us up.
It might be. Who knows? Yeah. So we were there, but they didn't meet with us. So
there's been a couple times like that throughout our history where
it's quite common.
You're like, where you're like, wait, why aren't these guys meeting with us? And then, or why won't they answer us? And then I don't know, a few months later, you hear that they're being acquired or something like that. You're like, oh, okay, I guess that makes sense.
Yeah, sometimes that's the reason. Other times it's clearly that it was nixed from on high. We were supposed to meet with someone and then the actual owner or the board or something. We might be supposed to meet with the, some companies and stuff, the CEO really can't meet with investors if they want to, because if there's a major owner or other people on the board that matter, they'll stop them from doing it if they don't want them to do it. So we've certainly had that happen where I'm sure that's the reason why is, so there's different reasons why it could be. Yeah, that's an example of went public you're looking at a chart there that like went public at a time to take advantage of it. And then, cause they split that company in two, the gaming part of it was split off from the, racetrack part of it. And then they took it public and everything. And then, what happened with the stock happened. So I think some people got very rich off of that, but certainly not outside shareholders. You
would consider it a pretty bad sign if we're reaching out to management and they just don't want to talk to us, right?
Not necessarily. It doesn't. I mean, I don't know. I don't think that's a negative sign necessarily. I doubt that I would want to talk to anyone if I was running a public company. So, what I meant though is they said they would meet with us, and then they didn't meet with us when we were there. So, which happens sometimes. It happens quite a few times. But just not commenting at all, not having any investor relations and stuff, I wouldn't necessarily take as that negative. But I don't know. I mean, obviously a lot of investors do consider it negative when they see that. Many of the cheapest things that we've found and the ones that have gone up the most, I would say they probably aren't going to talk to you. And it's not necessarily that good if they do talk to you a lot. So, and I don't know that the other thing is I'm not sure that it helps them out talking to you in a lot of cases, because probably as many times as we like what we've heard, we don't like what we heard, and it makes us less likely to invest. So I don't see the advantage for management to talking to you in these cases. But I don't know why as many of them are talkative as there are. It surprises me sometimes, but
yeah, sometimes you'll find like the most obscure of obscure, and honestly, sometimes they're way more helpful than even larger companies, and they're just not helpful at all. So I would say it's really just a crapshoot that way. It's totally random.
Yeah, but with these asset ones, probably the ones that didn't talk to us would have been the better ones to invest in. I think so. The ones that refuse to talk are probably the better ones to invest in from the asset value thing.
Is that because they just know like what the value is of their assets, like what their land is?
Yeah, some of them are scared. Mm-hmm. Yeah, that wasn't the case in this one, but some of them are scared that you're going to, yeah. Well, we had one where I said that to you, that we're not going to buy the stock because we know that the person is like, how many shares do you own? That's too many shares. I don't want that. The family doesn't want outside, so we just won't own it then. Okay. We're not going to buy something where they are like, they're trying to make sure that they have it, because they don't, this one's a different situation, but there are some, they don't have a lot of money and they own a lot of the stock, but they don't own all the stock. And, so if you own 30% of the stock and you don't have any money outside the business really, and someone starts buying up some of it, you don't like that because you think it's your business and stuff, but someone in your family took it public at one time and gave up a lot of it, and you're trying to hold it together. So yeah, there's a lot of family businesses and stuff where they wish that other people weren't involved. The way that the tracks have been run, it's not, International Speedway was a pink sheet stock and stuff, and was public for a very long time, and you could have invested in it. But a lot of these, I don't even know how well that did after it was publicly like listed on a major exchange. Its best run was probably when it was in the pink sheets. But yeah, they haven't been good for outside investors. A lot of them had super voting shares. Obviously, they have deals with the boards that award the races and stuff. Obviously, International Speedway, the family was pretty much controlling NASCAR and International Speedway, same family. And yeah, these weren't good investments for outside shareholders. They were taking public at prices that were high. They were taking private at prices that were low. Almost all of them were taking, some of them, I guess, were acquired by larger tracks, circuits of tracks, but a lot of them were taken private by the same families and stuff. So yeah, it wasn't a good thing for shareholders, outsiders.
Is there a common reason that usually keeps you away from investing in a company? Just one that always comes up. Is it more so price, would you say? Is it more so just the business itself that you don't like, or one that you don't think you would want to be invested in?
No, I don't think there's a common one. This would have been fine. We could have bought this. It seemed cheap. We saw it's cheaper than you might think. I think it's cheaper than is disclosed necessarily it's pretty cheap. But we saw other ones that were even cheaper, I'd say, and some that it went up even more, even though they weren't taken private. So yeah, there's lots of ones where you probably should buy the asset play thing. They had so that they made their money off the Delaware track. They really weren't making money off the track in Tennessee, but we saw it and we saw what they were doing around there and stuff. And it's crazy that they had this thing that big with that much land and everything that was making no money. So it was a very cheap stock, It could go wrong in different ways, but there's not good reason why it should. At the time, the largest owner was quite old, right? I believe so. I don't remember all the details on that, but I remember looking through who owned what stock and everything. But we saw other things. This is not the cheapest asset play we saw in person. It's not the one that went up the most in a short period of time. We saw something that went up even more. And yeah, they were very cheap versus their land and stuff. So this was very cheap, and other things we saw were very cheap. Why were they very cheap? Because there's no catalyst for why it should go up. They're controlled by people who weren't necessarily, you can look at the results over the time that was public and stuff. Returns on invested capital aren't necessarily that high. The stock often didn't go up over time. And And then when it is taken private or something, it's taken private either by insiders or in some deal where that's a part of it, I mean, the reason this was cheap to some extent, and definitely the reason some other things were even cheaper, is disliked insiders and what they were doing. Control company people figure it'll never go private or it'll never be taken over or whatever, and that's why you have cheap asset plays usually.
So we talked about VTS as a spinoff that you wrote up and liked. A spinoff that you also wrote up and did not like was Cars.com. So maybe you could talk through like the difference between a spinoff that you do like versus a spinoff that you don't like. It looks like, if I'm looking at a chart right here, Cars.com spun off around $25 per share in 2017. Here we are today at $18.50 per share. So
it had a lot of competition in the industry. They were going to spend a lot on advertising and stuff. So opposite supply situation. We were talking about, more constrained supply and stuff in oil. This looked like it was the opposite way. So yeah, I was just too concerned. It was too fast growing and too competitive an industry that way that everyone else was going to compete with them a lot. And then their previous results were better than their future results were going to be. But there was good and bad things. I mean, it was attractive to somewhat because they had certain deals that they already had in place and stuff. Because they're more connected to certain. I mean, it's a little complicated in terms of the history of the company and stuff, but they had more of a history in terms of involvement with legacy media stuff, which is how they were formed, really, and everything. And so the new agreements that they would have under that would probably be favorable and stuff. So I don't know. From a you can be a stock market genius perspective, it probably looked like a good spinoff, but from an owning it for the long term, not a good spinoff. Most of the competitors were losing money and willing to spend a lot of money. That worries me. That's why when people ask about the entertainment stuff, I'm like, just don't get involved. Don't buy Paramount. Don't buy Lionsgate and stuff. I mean, maybe they'll work out, but until people in your industry aren't willing to lose money and spend money trying to acquire subscribers at negative economic value and stuff, why be in the industry? You wouldn't want to be in the oil industry if people were drilling on economic wells and stuff, right? So you'd say, okay, I'll sell VTS. I'll get out of this. I'll do what, So you have to be insulated in some way from competition that is irrational, or competition has to be reasonably rational or something. But you don't want to be in industries where, so this is, at the time, this is a pretty hot industry, when this was a spinoff and everything. And so it was too worrying how much companies are spending on customer acquisition costs and everything to me. You had a lot of companies that were burning cash and were willing to keep spending on advertising. So, and that's my feeling on streaming and stuff is the same thing when people talk about it. I think it'll turn. I don't know when it will turn. I mean, I think it already is turning, that it won't get worse than it was, but there's still a level of willingness of companies to try to grow subscribers and everything, even when it doesn't make sense, and lose money. But at some point that will stop.
Is there a stock that really just sticks out to you where when you hear the name or you come across it, it just eats you inside because you pass on it in your own eyes? No. Is there anything that, really bothers you that you passed on?
No.
Nothing.
No. There's lots of stocks that I passed on that have gone up or that I should have bought or something, but no, it doesn't eat at me that I passed on it or anything like that. I mean, some of them, there's tons of examples. I mean, I was supposed to write up Transcat. I talked about this, and the stock's gone up a lot, but it never particularly did any. I mean, what happened with Transcat is that it was going to make a transition into a more service-based company. This is back when I was writing Singular Diligence, and it's basically sells calibration, measuring devices and things like that for life sciences and other things where measuring stuff is significantly important, right? Throughout the United States, basically, Puerto Rico, places like that. So it was moving more to a service-based business. We thought that would improve returns and all this. And look, if you look at the stock, that narrative has gotten out, right? And the stock has responded to it, but the business hasn't changed. So if you're looking at investing in things because, people will like it, because, if you find the thing that is the AI thing that people are going to be excited about, it doesn't even really matter if they get big in it. As long as people think that they're big in it is what matters. And same thing here with Transcat. I mean, one day it may become a very different business, but if you look at QuickFS, the business has not changed, and certainly not until the last few years have you seen any real change in terms of margins and stuff to reflect the service aspect of it. But we believe that would happen, and then I think that really got out into the market that has happened. But it's just been a re-rating of the stock. I don't see it's really underperformed in terms of how quick that transition is versus what I expected, and yet the stock has done better than I would have expected. So business not as good as I expected, but stock better. And there's tons of examples of stocks where that happened.
I was gonna say, have you ever held a stock or owned a stock and that turned out to be the situation where they pivoted and went a different way and it ended up being way more successful than you would have thought, or what you thought of when you thought about like the range of outcomes? Like they just went a totally different way and you made money differently than you would have thought? Or
no, I mean, Transcat, the stock I believe is up for the reasons that I would think, but those reasons haven't materialized. What's happened is there's a story about it which is out now and that people really like, but it's just a recognition of that story over time. But yeah, that happens a lot. I mean, I talked about FICO. It underperformed my expectations as a business, and it outperformed in terms of a stock. In the last few years, it's performed well as a business, but in the early part of the last decade, it was very middling performance, and yet the stock price kept going higher and higher and higher because there's a big recognition of the quality of the business and stuff.
Does that make you feel a bit, I don't know, like, I guess it's a good thing, right? If you held the stock or you still made money on it, but I always find that interesting where the business underperforms your expectations, but the stock does way better than you would have ever thought.
Yeah. I mean, most of your big returns, your 100 baggers and stuff, are through a lot of multiple expansion.
Yeah.
So here, multiples expanded from, it was less than 2 times sales. I mean, it depends on exactly how they're using sales, if they're trailing it forward or whatever. But certainly it was probably, it went at least 7 times up in terms of the multiple, in terms of the sales. And when we talked about Activation, the same thing happened. So, Activation probably went from, I owned it on an enterprise value to sales basis, sub 1 time sales to 8 times sales. And FICO probably went from 2 to 15 or whatever we just saw.
Yeah. I mean, out of 08, yeah, I mean, you're talking a little bit below 2. I mean, if you bought it...
Below 2, yeah.
Yeah. 1.6 times, 1.62, 1.31, and then it, went 2 and then skyrocketed higher.
Yeah. So the low was 1.3 times sales. The high is over 10 times that. Mm-hmm. So, which is crazy, but, it's not the right price today. The enterprise value to sales is too high today probably, and it was too low then. So those are your big opportunities, obviously, is to buy things that then have the big multiple expansion. Mm-hmm. So all the ones we talk about with the Microsofts, the NVIDIAs, the whatevers, that's what happened because Microsoft's price to sales must have been very low 10 years ago because it still had big margins, So a lot of it is the change in the price to sales, not the sales. I mean, that's the point where I talk about, how would NVIDIA or something not do great over the next 10 years? It's not that it won't grow sales, but it's that there could be a big... I mean, what is the multiple on price to sales for NVIDIA right now?
What did we say? It was was it 30 times or something like that? We could pull it up right now.
That sounds right. Yeah.
Yeah. Okay. Excuse me. I'm off. 37 times.
37 times. So given the free cash flow margin and the EBIT margin and everything, a 90% decline in price to sales is to be expected at some point from here. So sales can grow very high, but you're going to have a 90% contraction in the multiple possibly at one time. But not just possibly, very likely. I mean, 4 times sales is not going to be an unusual price for this stock historically or whatever. So, that's where like you'll be offsetting whatever growth you have in sales will be offsetting that contraction in the price to sales. But I mean, read the book 100 Baggers and all that, or 100 to 1 in the stock market. A lot more of it comes from the multiple expansion than people might think. A lot of it. Because it's a combination of the two things about, you want to have the earnings go up and everything over time, but it's also a big increase in the multiple. Yeah.
Yeah. When we talked about, 100 to 1 in the stock market or 100 baggers, I mean, if you look at those stocks on a chart, you had to have resisted selling for you to like have a true 100 bagger. You had to resisted selling so many different times when certainly throughout the cycle of holding the company, you knew it was probably, not cheap, right? More than fairly valued, trading at insane multiples and then seeing it drop, 50% a year or whatever. I mean, that takes guts when holding companies like that.
Yeah. But also, you've already gotten a lot of the return before then. I mean, I know that people are excited by the idea of getting exactly that return, but you can sell that and go into something else. Even if it's 20 bagger, right? That's a very big return that you have versus something else, and then you can get that return through other things. It's not that difficult. I would focus on at least just thinking in terms of like 10 times or something. But yeah, because the ones that do the 100, especially people like to focus on which ones got there the fastest and everything. And yeah, there's a big part where it'd be hard to keep it because it gets overpriced. Anything that's a 100 bagger probably was too cheap, is very cheap at the time that you could have bought it, right? But then also is usually too expensive at the time that you would have sold it. There's a few exceptions to that, but that happens a lot. It's just more likely that would happen if you're just randomly picking them out. Now, some you have that you can see over a long period of time, they would have returned 100 times or something and they would have kept going up over time. But you have to be careful about that, especially when you're measuring them as of today. You're likely, if you look right now for 100 baggers, you're likely to get a lot of stocks that are expensive today because they've recently become 100 baggers or something, That's always the case, to be careful about the measuring period. That's why those books that are older, both of them are older now, but the original one was quite old, is useful because then you can also ask, well, what happened to these things after that?
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding podcast. If this is the first time you are tuning in, be sure to check out all of our content on the internet. Go to focusedcompounding.com to get access to investment write-ups. We talked a lot about VTS today. Geoff wrote that stock up at focusedcompounding.com. If you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. And of course, wherever you are listening or watching us, be sure to hit that subscribe button, leave us a rating review. That still goes a very long way for us. So I'll thank everybody so much for tuning in to both of us, and we will see you in the next podcast. Take care.